Hi, this is Sue, and I wanted to start doing a series of updates on what's going on in the market and how, as a trader, you might be able to get an advantage, a leg up. How is it that you could see some of this happening? We're going to kick off 2016 with this series, and I know I'm a month late. I apologize for that. Personal stuff has kept me from doing many videos. But we're going to jump right into this. As you know, what we're looking at here is the divergence between where the MACD, two line, no zero line necessary, says price should be versus where price actually is. Okay, I'm just, framing this out. Last time the MACD was at this level, was over here. The angle is down, blue line below red line. This is a very, very weak structure on the MACD. So has it proven out? In other words, has this monthly, takes much longer to form this pattern on the monthly than any other time frame that we look at. So we've had erosion here long term on the weekly, keeps lifting up, pulling back, lifting up, pulling back, down, 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 and then finally capitulated here. And let's do a left view as well. You'll see here that we are showing that the MACD, forget everything else, and this doesn't mean it has to happen, but that the MACD would support price being at the same level it was over here. And where is that? Well, that's somewhere around 143.51 on the SPY. Well, we're still at 184. $153, 143. We're still here at 184. So this price reduction, this pullback in the market that has tested now, it's pushing down for the third, fourth time. This has signaled that we are really expanding the trading range here. When we were up here, we were in a very nice, very tight, very narrow trading range. We've fallen down into, let's call it this range. I'm just putting these at appropriate places where I see, it's going to pick off a candle or two. It doesn't have to be perfect. And you can even, put another range in here if you want at the low of some of those candles, somewhere in here. And these lines can be really thick. They don't have to be perfect. So we've dropped from this narrow, tight range after straight up. We've dropped and expanded our range into this wider area. So if we take these away and we just leave the two outside edges, you can see the story of what has happened with this MACD being predictive. It has pushed price down. Now, you can say, oh, no, the MACD is a lagging indicator and it's there because of price. That's fine. We're using it as a predictive indicator. So same thing over here. If we top out right across here as close to the top as we want to get, doesn't have to be perfect, and again, these lines can be very thick. You can use, a box, a rectangle to draw these instead of a line, and you could maybe make them and frame them out like that. That would still be, that would still be acceptable. That's where price is hitting its head against a ceiling over and over and over and over, sometimes piercing into that range, sometimes just coming up to it. More recently, just coming up to it. So this is what this looks like on the weekly chart. And again, price is not at an all-time low here, but the MACD surely is. It surely is. So let's get a bigger view of this weekly chart and let's see where the MACD would support price going. Again, I'm not predicting anything. All I'm doing is getting a feel for what's going on here. So let's get a 5-year weekly. Well, that's interesting. The MACD is even lower than it was here in 2013. 2011. Now, I don't like to read that far back historically. So let's just suffice it to say that this MACD is significantly lower than anything that preceded it up to this point. This whole last 2, 3, 4 years of run. Can we agree with that? Now, it doesn't mean it's going to just flush down and go there. It doesn't mean anything. It's just an observation that I'd like you to make for right now. And we're going to get into this in great depth in this little kick off the new year series I'm going to do, and how you can see this possibly ahead of time. Okay? So now let's look at the daily chart. Let's go back to our trigrid and let's look at the daily chart. So MACD has said lower, 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 lower. Yes, I'm bouncing, but lower, lower, lower. I would support price in going lower. So here is the most recent low. That's the angle down, and that's about appropriate. There you go. So now let's blow this one up and let's look at this one a little bit more thoroughly, shall we? And you can see that the angle here on price matches the angle here on MACD. So the read on this chart is not so terribly parabolically down, which means that in the short term, trading the daily chart and the real-time charts below it, price can go up and down here. It can bounce in here. Now, why is this important? Well, when you stop and look at this in the big picture, what these charts are telling you, let's get rid of all these drawings. What these charts are telling you is that if you use the predictive nature of this divergence that shows up on this two-line MACD, and you just let it sit out there and be like an early warning alert system. You know, just because you build a bomb shelter doesn't mean you're going to have to use it. Now, you might take advantage of it in a hurricane or in a tornado. That doesn't mean you're going to actually use it in a thermonuclear, instance, hopefully. So what we're doing here is framing out the reality. The reality states simply, on the higher time frames, the ones that take longest to form, the monthly and the weekly, the MACD 2 line would support price dropping significantly. It would support price dropping significantly. The real time, the daily chart, is going to be driven by the lower time frames below, the real time charts below, because it doesn't really have a massive near term divergence. But there's nothing here that's dramatic. So, path of least resistance, higher time frames, is down. On the daily chart and the underlying real-time charts, price can bounce around here. So how does this work? Well, we were telling this same story 6 months ago. While all of this was sitting up here very high, this MACD was eroding further and further and further. So as both of these higher time frames erode, path of least resistance becomes down, which means when the lower time frames indicators turn down, turn down, turn down, price can flush down. Stair step up against that MACD on the higher time frames, elevator shaft down is the most likely pattern. Now, does that mean it's going to happen? No, but that is the most likely pattern with this setup. And then what our job is to watch for these areas of support and resistance as they frame out, and then start your what if scenarios, or if then. So if we were to bounce up again, you'll notice this bounce has a lot less energy than prior bounces have so far. But we're already retesting this low, so the higher high is is not debatable at this point in time. This is going to be a lower high. So as we watch this action in here start to frame out what would happen. What would happen if the hourly, 30, 15, 5-minute charts gain some divergence here? Well, there it is on the daily. Could this connect and loop back up? Of course it could. These are pushing down against it now, saying, oh, no, you don't. No, 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 you don't. So the push up from down below is going to have to be pretty significant to push up against these and succeed. Well, we were doing okay off this hammer. We were doing okay in this V recovery until we kind of tapped out here. And now moving averages have rolled back over. 8 stayed below the 21 on the daily, position of weakness. MACD lifted up, gave it its best shot, and then over it came. So now, how do we map this out going forward now that we've got the longer term charts? So let's put the daily here now, the hourly here, and the 15. And let's see what this looks like in reality. Okay? And then again, we're going to spend quite a few short sessions here really looking at this. This is your bounce. Even here, that's your bounce so far. It's different on the hourly. You had areas of consolidation. It really struggled. It pushed up. It broke out. It came back in. It pushed up. And then when this crossed, this is what's known, I call it a pitchfork. It's a 50, a 21, and an 8. The 21 and 8 are EMAs. The 50 I usually use an SMA. This is a pitchfork. It's like a 3-pronged fork where they all converge, they squeeze together and then spread apart in either direction. And this just happens to be to the downside. Here it is on the hourly, and it involved all 4 of the moving averages, the 250 SMAs, the 21, and the 8 EMAs. And there it came. Down, down, down. Trying to hold now. So as you see these setting up, I want to get really organized now, and I'm going to walk you through how to give yourself a little bit of a leg up here, and then we're going to break it probably into 3 or 4 15-minute sessions. All right? So again, this is just the kickoff. This is just the first video for 2016, and welcome back. I hope this really helps you take a look at these markets in a realistic approach that makes it easier for you to, and I don't want you to predict, but you should be able to look at a series of what if statements. You know, what'll I do if this happens? How will I know what's going on? And then the other safety feature here is to get smaller positions and shorten your time frame for trading. In other words, you want to maybe back off your big swing positions a bit. Okay, as you can see, this is becoming very violent in here. Volatility is increasing. How do we know that? We just look at the VXX, the counterparty to the SPY. I like to trade these off each other. I like to look at them together. So here you go at the VXX, and we're going to talk about this as well. Here's your bottoming pattern, very similar to the topping pattern on the SPY. This doesn't really make much sense over here just because it's been down so long. And then here was your last double bottom, V-shaped configuration, and no surprise, up it comes out of there. And this is your volatility or fear in the market. They describe the VXX in many ways. It's the ETF representing the VIX. Okay? Very tradable. And there's your little pitchfork setting up right there. All 4 moving averages coming together and opening up and spreading wide. Okay? Doesn't mean it's going to run up to all new highs. Doesn't mean it's going to keep going forever. But what we're going to start doing now is really getting ahead of these what if statements. If this happens, then what will I do? Okay? Where is my advantage as a trader? I hope this helps, and I hope to see you again soon. Thank you.